All right, let's talk about one of the most fundamental concepts in all of finance, the cost of equity. It's this invisible number that drives huge corporate decisions, from multi-billion-dollar buyouts to whether a company even launches a new product. So, what exactly is the price of taking a risk?
Okay, let's dive right in. At its very core, all of finance is really just about one thing: the trade-off between risk and reward. The cost of equity? Well, that's the financial world's way of trying to put a hard number on that trade-off, at least for shareholders.
And it all really comes down to this one simple question. If you're going to invest your money into a company's stock and take on all the uncertainty that comes with it, what's the absolute bare minimum return you need to make that whole gamble feel worthwhile?
The best way to think about the cost of equity is like a two-sided coin. So from your perspective as an investor, it's your required return. But for the company, you flip that coin over, and it's the cost they have to pay to get you to invest your capital with them. They have to promise a return that's juicy enough to convince you to give them your money instead of, say, sticking it somewhere safer.
This idea is so central to business that it has its own name, the hurdle rate. I want you to picture an Olympic high jump bar for any new project a company is considering. The project's expected return has to clear that bar. This is exactly why a company like Apple might pass on a project that looks totally profitable to us, because if it doesn't clear their really high hurdle rate, it's just not worth the risk. It would actually destroy value for their shareholders.
So how in the world do you calculate this number? Well, the most common tool, by a long shot, is the Capital Asset Pricing Model, or CAP for short. It's actually a Nobel Prize-winning idea that tries to build a bridge between the risk of an investment and the return you should expect from it.
And here it is. I know, formulas can look a bit intimidating, but don't worry about it. We're going to break this down piece by piece. Each part tells a really simple and honestly intuitive story about how investors get paid for taking on risk.
First up, we have the risk-free rate. This is our baseline, our ground floor. It's the return you could get without really taking on any risk at all. Now, in the real world, we just use the yield on a long-term government bond, like the 10-year U.S. Treasury, as a stand-in. It's the foundation that every other risky return is built on top of.
Okay, next we add the equity risk premium. This is the extra kick, the bonus you demand for being brave enough to jump into the stock market instead of just playing it safe with government bonds. And this brings us to one of finance's biggest mysteries, the equity premium puzzle. See, for decades, this premium has been way higher than any economic model can really explain, which kind of suggests that we investors are psychologically much more afraid of risk than the theories say we should be. And finally, the star of the show, beta. This is hands down the most debated part of the entire formula. Beta measures a stock's systematic risk. That's the kind of risk you can't get rid of no matter how many stocks you own. And it measures it relative to the market as a whole. Basically, it dials that market-wide risk premium up or down for a specific company.
Let's make this really simple. A beta of 1, that means the stock tends to move right in line with the overall market. A beta greater than 1, maybe for a high-flying tech startup, means it's way more volatile, bigger swings both up and down. And a beta less than 1, like for a steady utility company, means it's less volatile. So a higher beta means more risk, which means the formula spits out a higher required return. Simple as that.
Now, here's a crucial point. If you just calculate a beta using old stock price data, you're driving by looking in the rearview mirror. But investing is all about the future, right? This is where a good analyst comes in and turns this academic model into a practical, real-world tool.
They use this really clever two-step process. First, they find similar companies and unlever their betas. That's a fancy way of saying they mathematically remove the extra risk that comes from a company having debt. This lets them isolate the pure underlying risk of the business itself. Then, they take that pure business beta and relever it, using the specific debt level of the company they're actually trying to value. This gives you a much better forward-looking guess at the real risk.
But for all its elegance, we have to be honest about CAPM. It's a model that was built for a perfect world, not the messy one we actually live in. It's built on some pretty wild assumptions, and that creates a pretty big gap between the theory and what happens in the real market.
I mean, just look at the difference. CAPM assumes this perfect world with no transaction costs, no taxes, and investors who are always perfectly logical. But the real world, of course, is full of trading fees, tax bills, and investors who are driven by fear and greed. All these differences mean the model's clean little answer is often a huge oversimplification.
This leads us to one of the biggest challenges to the model ever, known as Rawls' critique.
Basically, an economist named Richard Rahl argued that to truly test CAPM, you'd have to use a market portfolio that includes every single asset in the entire world, not just stocks, but real estate, art, everything. And since that's impossible to do, we can never actually prove if the model is truly correct.
And you can see the proof of this in the market itself. For decades, we've seen things that CAPM just can't explain. Small company stocks have historically delivered much higher returns than their betas say they should. The same goes for so-called value stocks. It just goes to show that beta, by itself, isn't the whole story.
So, if the main tool we use is flawed, what do professionals do? Well, they don't just throw it away. Instead, they use a much smarter strategy: triangulation. They use CAPM as one point of reference, but then they cross-check it with other models to land on a number that's way more robust and easier to defend.
And this gives you a little peek into what that analyst toolkit looks like. Sure, they've got CAPM, but they might also use something like the dividend discount model, which is great for really stable dividend-paying companies. Or they could use a simpler bond yield plus risk premium approach. Each model has its own pros and cons, and by comparing all of them, you get a much, much richer picture of reality.
And that brings us to what I think is the most important lesson in all of this. The goal isn't just to plug a bunch of numbers into a formula and get an answer. It's about understanding the story those numbers are telling you and, just as importantly, understanding their limits.
You see, financial models like CAPM are absolutely essential. They give us structure and discipline and a place to start, but they are never, ever a substitute for critical thinking. The model gives you an answer, sure, but the analysis, understanding the context, questioning the assumptions, checking your work with other methods, that is what gives you true insight, and that is what separates a good analyst from a great one.